Jim Forbes.
You're listening to the Inland Talk Express, 1050 AM and 106.5 FM, KCAA Loma Linda.
You're listening to an encore presentation of this program, KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show each and every week. We bring to you information in the mortgage industry about what's happening, what's trending, what's national, what's international that might affect your decisions. Not only your decisions, but what the rate is, what is the term, how much money is available, is the loan going to be easy to get, is it going to be terrible to get, what are prices like in the real estate market, how are you going to be affected by the fact that one area of the country is doing pretty well and the other area of the country is not doing so well if it comes to the economic news out there. I know that anybody who's in the tech world is pretty nervous right now because not only is Amazon and Meta and any number of other tech companies laying people off, but yes, your big tech bank just failed, and the U.S. government came in. Want to get to that a little bit later on. But if you do want to see this show, go to YouTube, Jeff Barton, The Mortgage Voice. That's where you can find me, this show, today's show, and past shows that have been on there, as well as we try to get on Facebook or Instagram, a couple of other social media channels, at least once a week to say what's happening in the market. So any of these places that you can go to and catch the show is a great place. Obviously, KCAA, where this show is broadcast on a weekly basis, you can go there as well. And they, too, have archives of the show. So any of these places, you can see the show, you can hear the show, and certainly we want you to keep up with what is happening because a lot of things are really in flux. I guess that's true of the last, 2-3 years in the pandemic world, post-pandemic world, which is what we're in now. So let's get right to a couple of it. I'm going to give a little news to use, then get into some of the banking that I was talking about. The 30-year fixed rate loan is at 6.75%. 6.17 is the 15-year. The FHA is at 6.20. 6.19 is the jumbo, and 6.50 is the 5-1 ARM. The 2 years at 4.173 and 3.602 is the 10-year. Now, the bonds, what are bonds, and why do we quote them on a weekly basis as to something you should pay attention to? Historically, we've tied the mortgage interest rate that you pay on your mortgage to the 10-year bond. And those particular securities that the U.S. government sells, it's really selling their debt in 10-year increments, is how it is determined what the rate will be. But that's kind of been out of whack. Not kind of, it's really been out of whack since we've seen not only the inversion of the 2-year and the 10-year, i.e. the 2 years yielding more than the 10-year, which usually is illogical, i.e. if I'm going to tie up my money for 10 years, I better get more money than if I'm only tying my money up for 2 years. But that's been inverted probably for about 12 to 18 months right now, and that usually portends what they normal and historically look at as a recession. Okay, none of those things are happening, or at least hasn't happened yet, and it's a really to-be-determined thing. The bonds themselves, bonds, whether they're corporate bonds, whether they're state-issue bonds, whether they're federal bonds, whether they're, as I said, U.S. Treasuries or some local municipal bonds, are the gold standard towards safety. And when people say, hey, we're going to take our money out and put it in a safe place, they're usually talking 10-year bonds. Now, why do I say that? Because there's, again, another odd occurrence happening with the latest round of bank failures. And these bank failures are as a result of the rising interest rate that the Fed has taken itself to do. 25 basis points are coming, and we will have raised the borrowing rate between banks. That's what they call the Fed rate. It is not the mortgage rate, it is the Fed rate. Now, the Fed rate does affect everything, but not directly to the mortgage rates. So just understand, when I'm talking Fed rate now, we're going to talk a little bit of why these banks are failing and what happens to the bondholders of Credit Suisse, which just came out in the last day or so with the fact that they're going to not pay off $17 billion worth of bonds. They're going to do what they call write it down. That's a fancy word for saying you're out, you're not getting paid. And imagine if U.S. debt was handled like that, which, again, is another thing we have to cover because the Congress has yet to raise the debt limit, which means that the bonds that bondholders hold, i.e. U.S. Treasuries, i.e. flight to safety around the world goes to U.S. Treasuries. Why? Because not once ever has the U.S. Treasury bonds defaulted. Never has it happened. That's why they're the most secure investment in the world. I mean, some of these countries, you cannot invest anything in their bonds because they default a lot. Companies default. Certainly that's, historically true. But because not only is the bonds held by debt holders of U.S. Treasuries, as well as bonds that are held by people who own bonds from a corporation like Credit Suisse. Okay, let's just get down to the basics of it, all right? And by the way, 14.5% jump in existing home sales last month from January. That's pretty good. Still down 22% year over year, but it looks like the housing market has recovered somewhat. And it looks like even the stock market has recovered somewhat because what we've seen, because of the Fed, Janet Yellen saying, hey, we're going to backstop all the depositors of these banks, and because it looks as if that particular panacea for everything. It seems if something happens, the government is responsible. Whether you think that's the right thing to do or the wrong thing to do, I can tell you right now, you can't run your life like that because there is no backstop for you. The only backstop for you is bankruptcy. And bankruptcy is the way to stop people banging down your door to come and get their money. Okay. The bonds that are offered by the U.S. Treasury, and that is debt. That's what a bond is. It's saying, in the future, we're going to pay you X amount of dollars, but you got to give us this money now. 2%, 3%, 5%. Well, because treasuries are sold weekly, monthly, yearly, and they're sold in increments, we in the mortgage business always look to that 10-year. I've talked about it before on the show, and I'm talking about it now. The 10-year is the bellwether for what the future holds for mortgage interest rates. And presently, that 10-year is at, as I said, 3.602%. Now, there's a spread between what the bonds are, i.e. what the mortgage base rate is, and then the amount of profit that they pile on top of that to make it worth whoever's issuing it worthwhile, or who is ever buying it worthwhile, so that in X amount of years it's going to be paid off. That is the bedrock of how debt is bought and sold, either at the corporate level or at the national level. Now, at the national level, because Congress is screwing around with this ironclad formula of success, and that worldwide people still see the dollar, they still see the U.S. Treasury as the safe place in bad times, is really messing with the psychology of how that works. So what happened recently with Credit Suisse, as everybody knows, Credit Suisse went out. They were bought by UBS. UBS came in and said, we're not going to pay the bondholders. Now, in situations where corporations go bankrupt or get bought out, usually what happens is it's the equity holder, i.e. the person who holds stock, is the one that doesn't get paid off, not the bondholders. The bondholders was what gave you the money to operate your business. The shareholders are just trying to make money on the up and down of whatever the stock is and whatever stock exchange it is. But this reverse of way it should be, obviously they're going to litigate it, but it's complete opposite. But it reminds me exactly of the dance they're doing at the U.S. Congress by not raising the debt limit. Now, I don't know whether you think it should be raised, whether you don't think it should be raised, but one thing is absolutely certain. Your money is more safe in your bank if the U.S. Treasury Department doesn't default on the debt they owe on those bonds. And you can bet your life that if you wake up one morning and that default happens, that your bank is now nervous, because your bank probably holds a ton of those securities. Your bank probably is in business with the U.S. government, borrowing money, lending it out, the bedrock of America is those treasuries. And whether you believe in the debt or you don't believe in the debt, yeah, we can talk about that in another segment. But right now, all these things at play, you really got to pay attention because it's really going to affect the mortgage interest rate, and we could see much higher rates if, in fact, we get a default. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening each and every week. We bring to you information that can affect you, but you know what? We also try to give you some information which you can think about in terms of a macro, like the world and the nation, and then we get into the weeds with our guests who come on the show and talk about products and solutions for you in the real world, because I think the combination of that really allows you to be able to not only feel that there's a perspective from my standpoint, but also some solutions. I don't want to just boot you out on the street with a terrible feeling. No, we have solutions. One of these guys is Dean Garrett from Remen, who has been with us, been on the show many times, and he joins us now with a couple of things that he wants to talk about, which I'm happy he does. Dean, how are you?
Doing good, Jeff. Thanks for having me. I can help in the mortgage world, but some of the other issues, and that's above my pay grade. So
yeah,
we'll stick to the mortgage world with me, please.
No, I think, well, we all have opinions, right? And I think what happens in times like this is people look around and go, why is this happening? And so to provide any perspective is really an opinion, because nobody really knows. I mean, there are those that know, but they're not going to tell me about it, so we just guess.
We'd all be in Vegas if we knew the future.
That's so true. Okay, so off air we were talking some about your HELOC product there. Give us an idea of what it is, how it works, and what are some of the costs involved?
Absolutely.
Thank you.
We call it our 5-day HELOC because it can be done in 5 days. That's how quick these things move. It's a little unique. It's different than any product we ever had. It's almost more like you're applying for a personal loan. I'll give you the quick step-by-step. All the loan officers go onto our website. They fill out this little mini application. That application goes into our help desk, and our help desk will send a personalized link to the LO, and the LO forwards that to the borrower. Okay, the borrower then clicks that. They can upload any information. They put all that information in. That's all the LO does is that initial 5-minute application. Then it's all up to the borrower to upload any of the income information, any of the things that we want. It all goes into, I hate to say this, it sounds a little shaky, but it's black box pricing.
Okay.
They've got a formula, they'll spit it out, and they'll give the borrower all these options. Borrower agrees to it, disclosures go out, there'll be 3 days for the disclosures, and that's how they can fund in 5 days.
Wow.
What makes it so quick and easy is the LO doesn't have to do any disclosure on it. They're all sent out to the borrower automatically with that link once they complete that. There's no appraisal done on the property, so that's the good news. And the bad news, where I say the good news, it's quick, it's cheap, it's easy. The bad news is it's an AVM.
Right.
And once that value comes in, that's it. There's nothing we can do. Even if you had an appraisal, you had something to show more, we're locked into that value.
Okay, so the AVM is really the key here, right? I mean, most people, especially in this market, are thinking their properties are worth more, but are we in a descending? Are we in an ascending market? It's very difficult. Does it figure that into the equation? How does that work?
Yeah, well, it's. I meant to check before our call, and I apologize on that, whose formula we use for the AVM.
Mm-hmm.
But if you're in an area where properties are turning over fairly quick, then you shouldn't have any problem with the value.
Okay.
It's a rural area, there's not a lot of sales.
Right.
They'll not come in. So as I said, it makes it a lot quicker. It keeps that cost down. We can go as low as a 620 FICO. You'll be limited to 65%, but you go a little bit higher and FICO, and we can go, for instance, 85% about the highest we're going to go on this.
Okay.
So
Okay.
a 680 FICO would get you 150,000
Okay. Is that the limit, the 150,000?
with 85%. If you get a little bit of a lower LTV, I can go all the way up to 400,000 with the 75%.
I see. Okay. Yeah, I was just going to ask you what are the limits. You just told me, so that's good. You know, I have clients that call me all the time because they're locked into these sweet 30-year 3% or less loans. They don't want to get rid of those, but they have equity they can't tap. So, you know, they're all looking for solutions. I guess that's a solution not only for the borrower, but for you as a lender. Obviously, we're all looking for loans, interest rates being what they are, and they may go higher, trying to stay viable as a company. You're looking for products to be able to solve problems, but also solve problems for you, too, so you can generate loans.
That's exactly right, Jeff. And the good part of all this, the LO is saying, well, what do I charge people? How much can I make on it?
Right.
You don't charge anything on it. We pay 2 points on these deals.
Okay, so up to, you know, whatever you said, up to 400,000, depending on the LTV or the credit score. So, you know, there's money in it, and certainly that particular percentage is kind of what most lenders are paying anyway on their broker comp plans. I mean, I know a lot of people aren't really privy to what we do, but it's all disclosed to the borrower, so it's not something that's hidden.
Exactly. Now, make things even better, if anybody's interested, if they email me, I'm just dean.garrett, Garrett, @remn.com. We have a webinar on this product coming up on April 4th.
Okay.
And I'll be happy to send them a link for them to register. They'll walk right through every step by step on this product, and you'll see how simple it really is.
Now, given that equity is really the name of the game here, right? People have equity, they want to tap into it, and we have such. I guess last year the total lost almost $1.5 trillion in equity, but that was after $4 or $5 trillion gains in equity over the previous 2 years. So there's still plenty of money in properties, right?
Absolutely. And this is a perfect way for you to stay involved with your borrower too.
Right.
Down the road, say rates come down a little bit, and they might want to do a refi and then pay off this second and save. You know, I know you're at 3% now. You're not going to touch it.
Right.
But rates come back down low fives.
Right.
You've got maybe around 10 or 11%. You know, you might want to refinance and take care of this and get you something right around 5. But if you need money right now and you want it pretty quickly, you want it pretty easily, this is a great product.
Dane, what do you do with these seconds? Do you hold them on your own books? Do you have is there a market for them?
Yeah, we're involved with a company called Figure.
Okay.
I'm familiar with Figure.
Uh-huh.
The founder of Figure, the one that started the, I'm drawing a blank, SoFi.
Okay.
Then he left SoFi and he did Figure, almost like Figure Technology. They're kind of a blockchain company that we had talked about one time merging with them.
Oh, I see.
Yeah. But
interesting.
Then with the crypto and everything else, both sides got a little cold feet. So
yeah, no, I don't. I think when the big boys finally jump in full force, that's when you're going to see a lot of people get more interested in that kind of investment or partnership. But it's still kind of the Wild West, in my opinion, especially with crypto.
I agree, Jeff. That's beyond my pay grade.
Yeah, me too. I just look at it, and every time you see volatility and the way, I just see younger people than me who know less than me thinking this is the easiest way to make a buck. I'm like, oh man, it reminds me of 2004, 5, and 6 when the candlestick maker, the butcher, the grocer, the waiter, they were all jumping into being loan officers. I'm like, okay, there's something wrong with this formula.
Yeah, remember the old neg-am days.
Yeah, exactly.
Oh.
Well, right. That's exactly right. Oh, man. So we have about a minute left. A little bit of prognostication, if you don't mind. I know that, nobody wants to get into that. Where do you see it short term in the next couple, 3 months? Do you see rates maintaining or are they going to go up a little bit?
Go up a little bit. We've been told as a company, fall. If you're looking for a decrease in rates, it's not going to be till fall.
Okay.
So everybody just got to hang in.
Yeah. Yep. No, I totally agree. Okay. Shout out. I know you gave us an email address. If you want to shout out a phone number and email address again, just so you can remind people how to get in touch with you with this good product.
Great. Yeah, phone number is 949-357-6444. And then for email, it's just dean.garrett, Garrett, @remn.com.
Dean, thanks a lot. Thanks for coming on. I appreciate it. Great explanation on the HELOCs. Appreciate it.
My pleasure, Jeff. Take care.
Take care. That's Dean Garrett from Remmen. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I am Jeff Barton. This is The Mortgage Voice. Thanks very much for tuning into the show. You know, if you want to see the show, you can go to YouTube. If you want to hear the show, we have a number of different podcasts, and we have a website. It's themortgagevoice.com. Lots of different ways that you can get with us and hear and see what we do each and every week. We've been doing it for about 9 years. It's one of the few shows that you can listen to locally through KCAA in the Inland Empire that talks specifically about not only the macro things that happen in the world that'll affect your mortgage, your ability to get a mortgage, your job, all those kind of things, but then we give you the solutions. We're going to interview a lot of account executives, loan officers, real estate agents that said, hey, look, it may be this, but here's some ideas that you can kick around and maybe give them a number and a way by which they can contact the solution giver to come up with the best plan possible for you going forward to purchase a house, refi a house, or whatever you feel like doing. Anyway, with us once again, now I haven't had Alma on the show for quite some time, is Alma Carrera. She's with Mortgage Assurance Incorporated out of Georgia. Alma, how are you?
I'm well, Jeff. So great to hear you and get to talk to you and your audience for sure. It's been a long time.
Been a long time. I know it's. There's been so much volatility in our business over the last 2.5 years, from the highest of highs to the lowest of lows. I'm always encouraged when I talk to friends that I haven't spoken with a while, still in the business, still providing solutions to their customers.
Exactly. So am I. I'm really excited to have this opportunity to catch up with you.
Okay. Tell us a little about what Mortgage Assurance Inc. does, and how it brings some solutions to the borrowers here in the IE.
Oh, great. So Mortgage Assurance Incorporated Wholesale, so we are a TPO lender.
Okay.
Basically has been around since 1997. So it's definitely seen some ups and downs of the market. So it's been around for a long time. You know, mainly doing the agency stuff, conventional, FHA, VA, SUDA, all of that important programs that have been helping our borrowers, especially in like you mentioned, in the last couple of years when we're all been really busy.
Right.
So we've definitely, do it well. We know those programs. We have the pricing, we have the service, we have the system, and also we basically operate on minimal overlays. We can even do manual underwrites in some cases. Obviously, talk to me and how I can help you with those. But,
sure.
We're actually specializing now in the non-QM field as well.
Okay.
Where we can have that necessary product, especially in our terms right now. Like you said, now that the market has changed a little bit in the last couple of years, non-QM has really become a more important program to have for the borrowers, for those self-employed borrowers, for things that have been having a hard time to not fit into those boxes when it comes to conventional agency stuff. So bank statements, P&L only, 1099s, everything related to a self-employed borrower we can help with. Even obviously a full doc that doesn't fit the box for the agency stuff can definitely fall into non-QM. And that's where, people like you and myself who have been around doing the agency stuff, non-QM, I find it fun, it's interesting, it's definitely a partnership developed between myself as the account executive, experience over 20 years, and the LO or the broker, that we can put those deals together for that individual borrower, because every borrower is a little different from another.
Sure.
Even self-employed to self-employed, as you know. So having that experience as a senior, experienced account executive really helps in this field, especially for some brokers who still or loan officer who shy away from doing the non-QM. I love doing them because they're fun to put together.
Well,
And
that's
like I
right,
said,
because you individually get a chance to, have input and be able to really solve by reworking or looking at the loan to say, oh, well, maybe we should submit it like this as opposed to like
exactly.
this. And that's an interesting thing to get a challenge to get involved with.
Exactly, because you're packaging the deal before it goes in through the doors, basically. So
Right.
you already know what your DTI is going to be, pretty much close, your LTV, all of the FICO scores. There's no guessing game. So you're able to then close it within, 30-day, less than 30 days span. Because you already have everything.
Excuse me, what are your loan to values? Just give us an idea of what you use as a criteria to do these non-QM loans. Is it 85%? Is it, what is it, 40%? What are you looking for in terms of the amount of money in the deal, or does it depend on each deal and then you basically look at it like that?
Correct. So each program, for example,
Okay.
on a bank statement, we can go up to 90%.
Okay.
We do require for 90%, we do require a little bit higher FICO scores in order to be able to get those kind of deals done.
What's
But you
that,
can still
700
get-
plus? 720 plus?
Correct.
Okay.
Correct.
All right.
But we don't even have to have 24 months. We can do 12 months and still have the better pricing, because in reality, why bother with 24 months when we already know there was a dip in our industry, So
Right.
the 12 months is just well as priced as a 24 months. So you could essentially get to a 90, 85, 80%, and even up to a 50% DTI on owner-occupied and condos.
Okay.
So that's an important part. And then also DSCR, investment properties, we're also doing those, So it's unique to whatever the borrower might need, that we have basically most of the programs that anybody is using right now. But again, it's the experience, knowledge to work with an account executive who's been doing the loans, who can put it together, and therefore you already know that the outcome is going to be an approval and a closing, less than 30 days.
Now, how do you price it? How do you come to what the rate is? Is that also driven by credit score and the amount of money in the deal?
Correct, exactly.
Okay.
Exactly. And there is depending on the FICO score and the LTV, sometimes they could be as low as 3 months reserves or, 6 months reserves, depending
Okay.
on the deal as well. So we're also working on some new exciting programs coming up on board on the non-QM side, doing the 5 to 8 units. So that's another, chapter that we'll be able to do. Currently, we're able to do 1 year out of foreclosure and short sale on the non-QM side, and then 1 year of bankruptcy. So that also is a unique thing that we're able to do.
Now, Mortgage Assurance, Inc., they're kind of new in Southern California, or have they been here for a long time and I just never have done business with them?
Exactly. So I'm based out of El Segundo, California. So
Okay.
I'm definitely an LA girl.
Sure.
But the company is based out of Atlanta, Georgia, and they're just now expanding into California.
I
So they've
see.
been primarily East Coast and now expanding into California. So being able to have your loan officers or brokers contact me to do business, they're definitely, have the market share right now where, we're a hidden secret. Not a lot of people know about us, for sure.
Now, what is the strength of the company? Is it the financing they have behind them? Is it the years of experience? What do you hang your hat on in terms of when you're assuring people that, this is a great company to work for? Not only that, but they're a great company to do business with.
Exactly. And I think it's the twofold that you just mentioned. The fact that the company has been around since 1997. They've definitely seen the market, the ups and downs, and
Right.
they're financially stable, the backing to be able to continue to close these deals, especially like the agency and FHA and all that, being minimal overlays. That just shows you that they know what they're doing, and therefore they know what they're able to close and close it, positively. We were, for some, we were able to do like a TBD, to be determined. So
Yep.
if you wanted to look for a pre-approval, I can definitely help that. And we are able to do manual underwrites for those borrowers that maybe have something, life-changing that is affecting their credit score, and then we can work through that. So it's all just conversations by contacting me that I can definitely help the loan officers or brokers listening.
Okay. How are you handling underwriting? Is that local, or is that back in Atlanta, or is it someplace else?
Both. We do have a small team of East Coast, West Coast.
Okay.
But the bulk of the underwriters are, East Coast.
Does that cause a problem?
No, not at all.
Okay.
Not at all. Just to, you and I would understand this, but we don't even have account managers because the underwriters take responsibility to look into the files as quickly as possible.
Oh, that's
so
excellent. That's excellent. Well, Alma, listen, I really appreciate you coming on. We're through to the end of it. I want to make sure that you get your information out to the general public. If you could share either your email or your phone number or both, that'd be awesome.
Yes, of course. Thank you so much for the
Sure.
opportunity. Alma Carreno, Carreno, and you can contact me on my cell, 310-321-8259, or my email is really simple, Alma, ALMA, at MAIbroker.com. MAIbroker.com is my email directly.
Well, Alma, thank you very much for coming on the show. I always enjoy it. Love hearing your voice and that you're still out there plugging away, solving problems. Thanks a lot for coming on.
Thank you, Jeff. Always a pleasure. Have a great day.
And you have a great day, too. That's Alma Carreno. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Really appreciate you listening each and every week. We bring solutions to you via the people we bring on the show, experts in the field, account executives, real estate agents, people from the title company, anybody that can bring to you immediate information that you can use. Obviously, my 10-minute or 20-minute different segments. I talk about national and some other things that might affect rates in the long term, short term. But these people that we bring on, our guests, and the next guest is no exception, are really the people who bring solutions via the programs that they offer through the companies that they work for. Justin Simpers from Orion is one of those people. Justin, how are you? Thanks for coming back on the show.
Yeah, I'm all right, Jeff. How you doing? Thanks for having me.
Oh, thank you very much. We're just trying to get through a really rough patch in our own business. I mean, we've, over the last couple of years, it's really been a roller coaster. We were so busy we couldn't breathe for about 18 months, and then the floor fell out, and, obviously we're seeing the ramifications of all this, whether it's inflation fighting or just, people, trying to do what they're ever trying to do. We're just trying to get loans out the door so that we can stay in business, and I don't know how you're faring, but I assume some of the products you're using are helping you do that.
Oh, yeah. I mean, it's definitely the products that, that just like, gravity takes effect and it's always going to win, So
yes.
What goes up is going to come down,
That's a great way to look at it. I like that.
I mean, it is, you're never going to defeat it, You have to be in outer space for that, But, yeah, I mean, products are key in this market, and it's alternative documentation. I mean, in the DSCR business, right? That's the debt service coverage ratio for investors buying properties, which is just a super hot commodity in the market right now. And down payment assistance has always been there, but I would say, alternative documentations, that's where it's at. I can tell you that, I've been seeing a lot more, 1099 only borrowers,
right.
12-month bank statement borrowers, CPA prepared P&L borrowers. A lot of people ask, how are you skirting the QM, rules of, borrower ability to repay, and so they still come with, it's still the responsibility of the borrower to show the ability to repay, like bank statements. That's easy, shows cash flow. 1099s still need to be backed up with some sort of bank statements,
right.
Correlating with the deposits and CPA P&Ls would be much the same, So, it's still working, and it's still a small segment of the business, though.
Surprisingly, I would think it'd be more.
It is.
Yeah,
it is. It's very interesting. The market has not shifted to the non-QM space as hard as I thought. I thought when like the guys like Change Wholesale, they rolled out that stated deal. I thought that was going to blow up, but it really. It hasn't done what I thought it was going to do, and so it is interesting, though. It is interesting. It's just one of those things that has me pondering. It's much like the market, right? It's like you could take a look at the market right now, and you're like, well, the rates are up, 3-4 points over the last 16 months or whatever, but values don't indicate that, and the values are actually holding, and I have people ask me all the time, friends and stuff, hey, should I buy? And my answer to that kind of, blunt is yeah. I if you can afford it, yes, I would. And my thought process is on that is the investors are swooping up on the market. That's what's keeping it going. And, if they're going to buy whole neighborhoods, you better get one of those houses because in my mind, when the rates go back down, the values are going to probably go up substantially, in my opinion. So it's just one of those funky times, and so
I looked at Bezos's company and some of these other corporate entities buying up properties, and also there's a great deal of people out there saying no, it has nothing to do with it. The fact that the market is the way it is, it's a very small segment. Like you said, hey, if there's a company out there buying up wholesale, whole blocks and whole sections of town, of course it's going to affect the amount of properties available for everybody else. It's going to artificially keep the prices high, and all these people are doing is putting all those properties back on the market for rents. So we just don't have enough houses. I think that's the bottom line. Has been like that for about 10 years.
Yeah, and you look at new build permits pulled in California, it's down.
Really down.
Substantially. It's like, well, that's actually unprecedented, right? So, existing inventory is kind of it, and it's not like, Texas, suburbs of Dallas and stuff like that. It's just those places are going bonkers, but also values are going bonkers to the point of where I think, it's getting a little crazy out there. I mean,
well, you see that Elon Musk, right? He's building houses for his own employees. They can't afford the other employees. If they're going to work and live in Texas, they got to have housing. So he's building them houses. I think it was 110 the last count.
Yeah, that's crazy.
Yeah, man. I think it's really crazy. Okay, so market being the way it is, where do you, I hate to do this to you, but I'm going to ask you anyway. Where do you think it's heading? I mean, I've heard fall it might come down a little bit, or it may go up to 8.5%. I mean, so.
I mean, I'll be honest with you. I think that we're going to have a rough year rate-wise. I think it's going to be a rough year. It's going to be a 12-month period coming out and into 2024 where we start to see some relief probably within the next 12 months, which would put our cycle at about 2.5 years of, of what we've been in. So I think I really don't think we're going to go very far down or up from where we're at over the next 12 months, but I think it's going to tick up a little bit, in my opinion. That's just, what I think. And, and the thing too is like the stock market volatility, but the real estate safe haven is almost like an unknown of what's going to happen, because this is almost a reverse cycle of what we saw in 2007, and so right now you see all the depositories and banks that are closing, and lenders as well, and what's happening with that is the net loss carryovers. Those are what's killing these people and spending. If they're at $1 million of cost to run a month, and the net loss carryovers are hitting their books, making it unable for them to breathe anymore. So it's going to be interesting over the next 12 months to see, what shakes out. I have my popcorn ready.
So on this show, we talk about the 10-year all the time, and I tell you, this is kind of the historical way that we look at mortgage interest rates as we watch that 10-year. Well, because the inversion with the 2-year for the last 18 months, it's been kind of the reverse, like you were saying, on another front. But we look at bonds, and I look at corporate bonds, and I just saw how Credit Suisse said that they're not going to pay their bondholders; they're just going to pay the stockholders, which is the reverse of usually what happens in any of these situations. So it really makes me nervous about, what happens with defaults now in the U.S. and with Congress still futzing around with not raising the debt limit. It makes me nervous for the American borrower because, you're only insured up to $250,000, in your bank account. So there's a lot going on for people to chew on. I like real estate. I like the investment in real estate. And as you said, being able to purchase in the real estate market is really the key, as long as you can afford the monthly.
Exactly. It's the only tangible asset that you have that you
Right.
can, stake your claim in.
Yeah, no, I 100% agree in that. Listen, can you shout out a way by which people can get in touch with you? You offer a lot of great solutions, been around a long time, a real veteran, plus you have a terrific online presence. I always enjoy listening and watching you. You laugh, but it's true. You're pretty good. I appreciate that.
Yeah. No worries. Justin Simpers at gmail.com is my email. And then also justinsimpers.com has all my videos and links to the social media and stuff like that. So, I appreciate that. And, if anybody wants to talk shop, get set up, or need some help, shoulder to cry on, reach out. I'll help out.
Justin, that's great. No, that's really good, because I have always taken that approach myself. I mean, the show is the show, but certainly I'm here because, I enjoy helping people. And, in the mortgage industry, it's not simple. And, you really need some professional guidance to make sure that you don't make bad mistakes.
Right. Yeah, no, I appreciate it. I appreciate the time, Jeff. Thank you so much.
Thank you, Justin. We'll talk to you soon. Appreciate it.
All right, Jeff.
All right, bye. That's Justin Simpers from Orion. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Hi, I'm Jeff Barton. I'm your voice in the mortgage industry, talking with Daryl here, just fooling around talking about whack-a-mole. But, the banking crisis that we see not only locally but also internationally, they've called it whack-a-mole, i.e. a problem comes up, you whack it down. So that's what Janet Yellen does domestically, and that's what they did in Switzerland by the government stepping in and say, hey, UBS, you got to buy Credit Suisse. So it's sort of as it pops up, this is what's going to happen. Now, if you follow this stuff, and you may not, because most people look at it and go, hey, if I ran my household like that, I couldn't run my household like that, because they don't have debtor's prison, but you'd be in bankruptcy court and you'd be in all kinds of hurting if you were allowed to be able to do the kind of things that these lenders were doing. Now, okay, so what is happening in the lending world, and why did these particular banks in the U.S. fall? Well, because before the Fed began raising their short-term interest rates, and those interest rates are interbank rates that they lend each other for the overnight liquidity requirements of a lot of these institutions. Now, some of the liquidity requirements, i.e. you have to have X amount of dollars in the bank, or X amount of liquid assets available to you in case there's a run on the bank. Well, what happened is they took the amount of money that they had on deposit and they invested it in bonds. Now, bonds at the time they invested it, whether they be 2 year or 10, whatever the term they were, didn't realize that if bonds actually rose, i.e. if you're going to get 2.5% or 0.25% on a bond, and you put all your money in there, and then the price or the yield on the bond raises to whatever it is, those bonds that you have at 0.25% is probably worthless. Well, that's what happened. And the bonds, in order to cover some of the expenses that were obligated by the bank, they couldn't do it because the bonds that they tried to sell just wouldn't cover the current debt that they had, based on people taking their money out of the bank and putting it into higher yielded bonds. So all these banks, the bank's Signature went under, and SVB went under, Credit Suisse went under, and they're looking at the fourth bank, which, by the way, they're trying to, again, whack-a-mole these banks. I heard Jamie Dimon, he who is the CEO of Chase Manhattan Bank, has been for a long, long time. Very smart guy, very good guy. But he, too, has led the charge to try to recapitalize. And let me see, what's the name of that bank? It's not Signature, it's not SVP, it's, First Republic, that's what it is. And so you might see more and more of these types of situations popping up. And again, we'll see what the whack-a-mole dudes do. Anyway, I'm Jeff Barton. Thanks for listening to the show. If you want to hear this show, you can go to a number of our different podcasts, and we are on a ton of them. Daryl, do you have a list of those? Somewhere?
I sure do, Jeff.
Excellent.
somewhere over the rainbow.
Oh, I know.
Whack-a-mole land. It's Apple Podcast, Google Podcast, Spotify, Spreaker, Stitcher, iHeartMedia, Audacity, YouTube, podclips.io, and The Mortgage Voice.
Okay, The Mortgage Voice is our website. Go there. You can see and hear a lot of what we do on the show on a weekly basis, as well as see and get in touch with some of the people who are guests on the show. Podclips.io, great place to go. It's a central location where you can listen to any number of different types of podcasts in one location, whether it's lifestyle or sports or health or finance, which I am, or a number of other items. Go to it, podclips.io. Okay, thanks very much for tuning in. We covered a little bit of the banking situation, what's happening. One thing that is really overriding the entire situation, and it always does, and for those of us in the business, we get callous to it. I do a little work with some ambulances through a part-time thing that I'm doing, and I notice that after a while there is not a callousness in a mean way, but people just, they get toughened to what's happening in emergency situations, whether it's a stroke or a heart attack or a car wreck. After you do 50, 100, 1,000 of these, you just don't react to it the same way, even though it affects the people exactly the same way. It's kind of that way with people like me in the mortgage industry or in the banking industry. We've seen these things happen before, especially in 2008, and since then and before then, we've seen it happen any numerous times, whether it's the dot-com bubble back in early 90s, late 90s, we had a recession. It's just one of these things where we get callous to it. However, for you as the consumer who is listening to the show trying to figure out, okay, how does all this work and why am I not able to sleep at night? Well, what underlines the entire system is this thing called trust. I trust that if I do this, I'm going to make this amount of money. You buy a house, right? You pay title insurance because you trust that the title insurance is going to cover you from somebody knocking on your door one day and saying, hey, wait a second, this is my house. Here's the deed, and this other guy sold it to me first. That's why you have title insurance, so that you can trust that when you buy a piece of property, especially in the U.S., it was one of the bedrock foundational principles and why the country was founded was because transfer of individual property is in perpetuity. You own that outright forever. You pay taxes, of course, but for the most part, nobody can tell you what to do on your property. Well, imagine if that particular aspect of what made us, the U.S. really different from other places, like you go to certain places around the globe, still today, it's the government that owns your property, or the church that owns your property, or a collective that owns your property. When you own your property, that's a big deal, right? So imagine if that went away and all of a sudden the security of your property was in doubt. That's called trust. You trust the system works. It's very similar with the way the banking system works. I borrow money from the bank in order to have my mortgage, right? The bank requires that I pay it back, and if they don't, there are a set of rules and regulations for them to recoup their losses. This is trust. This is the system that we're in. The problem with the way things are being done currently today to upset that trust is playing with fire. It really is. The debt limit is what I'm talking about. I talked about it in an earlier segment, but just to reiterate, when you tell people to buy our debt and that we promise to pay you back, and as a result of that, and that has yet to ever default in the 250 years of the country, if it defaults, the bedrock of what makes us us, i.e., it's a place that you can put your money safely, means that trust has been broken, and the effect on how people treat the United States and where they put their money in times of trouble, they're going to look elsewhere. And that sovereign money, that influx of funds based on that to U.S., equities, whether they're in the stock market or the bond market or in the real estate market, has always been a source to buoy what is going on domestically here in the U.S. and has kept prices stable. It has kept you and I under a roof that is one day worth one thing, and guess what? Next day it's going to be worth a little bit more. That's just the way it is, and that's the trust factor that I've been talking about. Now, politically, I don't know, and I don't have the answer to the banking issues and the banking problem. But I do know that trust being the center and the core of what you do when you go buy a house, what you do when you go and go to work each week and you have your paycheck that comes in or automatic deposit, that's trust. That means that, yeah, it's going. That's why the whack-a-mole that we've been talking and laughing about that current banking has been doing, or Jamie Dimon trying to help out, what bank was that? Jeez, I can't even remember the darn bank.
First Republic.
First Republic, thank you very much. Yeah, all these things. Whether Janet Yellen is helping these banks by doing that exact same thing. The trust that is available out there, because the U.S. has never defaulted, is a big issue. And it, like I say, okay, let's just move on. All right. So, okay, another thing is, I'm going to, quick, I got a minute left. In Europe, when you make a deposit in a bank, you are insured, like FDIC here in the U.S., up to 1.5 million euros. 1.5 million euros. Do you know until 2008 it was $125,000? That's it in the U.S. After that, your money could be gone. So does that mean if I have, I don't know, $500,000 in my bank, I should go out and open up 4 bank accounts? Well, they raised the FDIC insurance to $250,000. So the answer is, well, maybe, because if you're only insured to X amount of dollars, maybe you should make more bank accounts to make sure that all your money is actually insured. Check with your banker. Check with your lawyer. I'm Jeff Barton. Sorry for that bit of advice. I really appreciate you listening to the show, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Legacy 1050 AM, Southern California.